Well, in this video today, I'm going to share with you how I made $150 in just a few days thanks to trading a covered call on Webull app. Let's get right down to it. In this video, I'm going to be sharing a beginner's view on selling covered call options. Now, if you are a little bit more advanced, this might feel like a little bit of child's play, but if you're just getting started, hopefully this will be super helpful to you. And make sure you subscribe because I have other videos coming on options trading, specifically cash secured puts, buying calls, buying puts, selling puts, the wheel strategy, iron condors, and so much more. But let's get started with, of course, the basics. Now, there's a couple terms that you need to know before you get started. And by the way, to save you some time, I have some chapters in the description below. Hop to whatever you want to see and make sure you come back if you have any other questions. Here are the terms that you should know before you get started on a covered call. The very first one is expiration date. This is the date that you're going to select. In the case of selling a covered call, the expiration date would be the date that if the price hits what you select, you would have to sell your shares of your underlying stock or ETF. Next thing is a contract. Very simple. One contract equals 100 shares. So in order to get started with a covered call option, you must own 100 shares of whatever stock or ETF that you select. Next term is being assigned. Being assigned means that somebody's going to exercise your covered call, which means you're going to sell your 100 shares that you own. There are a few other terms such as in the money, out of the money, which we'll explore in today's video as well. So let's get started. First thing I'm going to do is I'm going to pull up my Webull screen right over here. Now, before I do that, it's important to know that I'm going to be doing an ETF trade today. I own currently 100 shares of VTI. That stands for Vanguard's Total Index, Total Stock Market Index. And because I own 100 shares, I am going to sell a covered call option on those 100 shares. Now, you can do this with a single stock. In fact, make sure you subscribe because I am going to be sharing with you some covered call options that I'm doing on some other single stocks, such as Apple, Tesla, and things like that. But for today, we're going to do an ETF. Now, a great way to look at this, just for beginners, a great analogy here. Somebody once told me that a great way to look at covered calls is very similar to real estate in a sense. Let's say you have a house, but you want to buy another house because it's on a great deal. So you buy that other house and your point is, I'm going to buy this house and this second home is just going to go up in value. Then when it's up in value and I have a lot of profit, I'll then sell that second home. Are you going to just let that second home just sit there until it rises up in value? Maybe it's going to be like 5 years or 10 years from now before it gets to the price that you want to sell it at? Probably not, right? You're going to get somebody to go in there and rent the house out. You're going to rent it to somebody who wants to live in the house. That way you can generate some passive income while you wait for the value of the house to go up. That's kind of similar to what we're talking about with selling covered calls. I own 100 shares of VTI. Now, my hope is someday it's going to go back up. This year has been bad for the stock market in 2022. It went down. So of course, things aren't looking good. But in the meantime, while I wait for 5, 10, 15 years from now for it to go back up, why not rent out my shares to generate some additional income? That, in a sense, is what selling covered calls is all about. The very first thing you're going to want to do is open up your Webull app. If you don't already have Webull, click the link in the description below. Get yourself started because they are giving you free stocks just for signing up and depositing your first amount to trade with. It's just such a great deal, so check it out down below. But come up here to the search bar and type in whatever stock that you want to. I'm going to type in VTI because that's the example we're going to use today. Now remember, I already own 100 shares. If you don't, and you want to sell covered calls in whatever ETF or stock that you're interested in selling a covered call on, you got to first buy the 100 shares of that asset. But because I already own it, I'm already clear there. Now, right down below here, you're going to see two different buttons, trade and option. We're going to click on the option button in just a couple moments. Now, if you don't see this button available, you do have to apply for options trading. In order to do that, just go over to your account settings and you'll find the option that says apply for options. Take a shot every time I say option. Anyway, so right over here on the very top bar, you see it has the chart. That's currently today's price, but then also look at options. Let's click on options. This is the key. Once you do that, it'll take you over here. Do not worry about all these numbers. Trust me, when I first saw this, I also was like, what am I looking at? But don't worry, we'll explain it all in today's video. Let's start by setting up our view the right way. What I want you to do, come over here where it says single option and then it says both. Tap on that and change that to calls. We only want to look at the calls. We do not want to look at the puts in this case. And you don't want to accidentally do something with puts and totally mess up everything that's going on. Let's make it easier on ourselves. Just select calls. Then you see up here it says 11 days, 18 November 22, 100. Just tap on that and then you'll see it collapses everything. And here we have all the different expiration dates. Now this is exactly what I like to look at. The expiration date is a critical function of what you're gonna do. I like to look at things at least 1 month, 1 year, or even 2 years out from the current date. That gives you a little bit more flexibility to ride the wave with the stock market and doesn't risk you being assigned. My goal is to not sell my 100 shares. If it happens, it happens, but my goal is not to have that happen. So in our example, what I'm gonna do is I'm gonna select June of 2023. That gives me plenty of time as of the recording of this video to have fun with the fluctuation of this particular call. So click on that. And then what we're gonna do is we're gonna come over here to the very bottom. Do you see the little filter bars? Click on that. And what we wanna do is set the strikes to at least 30. If you tap on that, it gives you the option. Typically, if you're just starting, I think it only gives you 6. I don't think that's enough. I like to set it on 30, but you can choose. You can do 50, all, 20, 10, it's up to you. 30 is my jam. Then I leave everything kind of similar on this thing. I do go into the columns bar, and then I do want to look at the volume. You see right down there it says available volume. Just click on the eye. It will then pop up here to the available columns in your options trade. Once you do that, come on back and then everything should be good to go. Here we are on June 16th, 2023. Now, everything that's in blue, that's shaded down below there, that's what we call in the money. Here's the best way to look at it. Right now, the current price of VTI, as of the recording of this video, is $190.62 per share. Anything below the current price, in this case, when we're looking at calls, anything below that price is called in the money. It's inside that stock price. If it's above the current price of VTI, it's what we call out of the money, or OTM. So everything here, 191, 192, all the way up to, I have 30 filtered, so 225, that's considered out of the money. Now, what could happen here is, let's say tomorrow, the stock price of VTI goes up to $192 per share. That means the strike price of 191 and 192 would then be considered in the money. And then what you'll see, those two will then be above here and be shaded in blue because they're considered in the money. What that means is if it becomes in the money by your expiration date of June 16, 2023, that means the buyer of your options contract has the right, but not the obligation, to take your 100 shares of VTI. Again, the goal is not to have that happen, which I'll explain in a few moments. Now you might ask, well, why would somebody do that? Why would somebody want to basically buy a call from you, spend all that money, and then if it reaches their additional strike price, they're gonna go ahead and buy that? Why would they do that? Here's exactly why this would be favorable for somebody. Let's say you have a trader and they're like, right now I don't want to buy VTI at $190 a share, but I do want to buy it if it goes to $210 a share. Again, if you're probably like, why? Why wouldn't you want to just buy the dip? Buy it $190 a share and then you can ride it all the way up. They may not want to do that if they're feeling like the stock market is a little bit too volatile or it might go down even more. They might not want to mess with all that. They only want to enjoy the ride if they know for sure it's going up. And by buying a $210 call, they can let it rise up to the top. And their goal would be, I want to capture it at that price because by June of 2023, if it soared to 210, I have high confidence it's going to go to 250, 300, and to the moon. And here's the best part for that person. If they buy a call and they bought it at $210 a share and it soars up to $300 a share by the June 16, 2023 expiration date, guess what happens? They get the opportunity to buy those 100 shares at $210 a share. Even if the price goes for $300 a share, because they have this options contract, they get to now buy that for $210 a share, and immediately they make all this profit from the difference of $210 a share to $300 a share. That's why somebody would buy a call option. So we know that buying a call, that's kind of cool, right? So that would be if you're thinking, okay, if it goes to this point, I think it's bullish and I think it's going to go to the moon, so I'm going to take advantage of it. But in this case, we're not buying a call, are we? We're selling a covered call. And the difference of selling a call is we actually don't want the price to go up in the near term, unless we're okay giving away our 100 shares. In this case, I'm not. I don't want the price to go to whatever strike price I select. I want it to actually go down and stay away from my strike price. So let's say I decide I want to sell a covered call at $210. If it doesn't reach that number by June 16th of 2023, the option expires worthless, which means I get to pocket all the money and I get to keep my 100 shares, as long as it doesn't go up to 210 and become in the money. But even better yet, I don't want to wait until June of 2023 to profit. I want to make a couple $100 now. And how I would do that is I hope that this price actually goes down in the short term. Again, long term, I want it to go up because I want to make my money on my shares. But in the meantime, let's let it drop a little bit. And maybe you think, you know what, with everything going on in the market, I think it could drop even more. And if it does, I'm going to make some extra money. What we would want is for this stock price right here, this 190.62, to keep going down, down, down. And if it goes down, what happens is the price of my options contract becomes a little bit less expensive. Here's how that would work. Let's go up here to this example of $191 a share. If I decide to click on 191 and I sell a covered call, look at how much money I'm going to make. $1,610. That's amazing. And you get that money immediately. As soon as I hit the sell button, I get $1,610. Now, what you want to have happen is you come back here and you want that stock price to drop, because what will happen is this will become further out of the money. So for example, see how you come down here, $16.20, $9.30, all the way down to $3.20. Now you multiply that by 100 because remember, one contract equals 100 shares. But if it pushes that price down, all of these numbers become a little bit less. In fact, you can actually see that. Let's click on this $225 options contract, and you can see how up here at the top it says daily. Look at the top here. Do you see where it says $4.50 all the way down to $3.30, which is what it's at right now? So that means that if I would have bought VTI back in late October for $4.50 per share, that would give me a $450 credit. Today, I could actually give that contract back because it's now only worth $350 and pocket the difference. That's what we're after. So let me walk you through an actual example here. What I'm going to do is I'm going to do the same thing we just looked at today, and I'm going to execute a covered call in June of 2023. Now, there are a lot of things to know, such as the Greeks and such as the volume, that I'll share with you in other videos. So make sure you subscribe. This is just a general overview of how to sell a covered call on Webull. But on this channel, we'll dig a little bit deeper into what all those things mean and how they can work to your advantage or to your disadvantage in the near future. So right now, I'm going to use the Webull desktop since I was using the app a little bit earlier, just to give you a different example. If you sign up for Webull, you get access to both. You can use it on your phone or you can use it on your computer, as I'm doing right now in this example. But I'm going to go and I'm going to select the June 16th, 2023 VTI $210 strike price. That's my goal. If it hits 210, then I'm going to lose my shares. If not, I'm chilling like a villain. And I think the price is actually going to go down over the next week. So in this case, what I'm going to do is I'm going to select this particular option. And down below here, I want to do one quantity at a strike price of 210, and that would be a limit price of $900. So what I'm going to get immediately upon executing this trade is $900. That's amazing. Now I can do whatever I want with that $900. I can go out and have a beer or two, or buy gas with it because gas prices are so expensive. But what I actually do with this, by the way, is I keep this money in cash, because at the end of the day, in order to make money, you do have to give this money back. What we're doing here is we're selling a covered call, so we're selling to open our position. And in order to get out of the position before the expiration date and make the money, we have to buy to close. So we have to buy back the contract to close it out. And what that means is we're going to actually have to buy money back and pocket the difference between, in my case, $900 and whatever we end up with. So in any case, what I want to do is I want to go ahead and place this order, and then immediately this screen pops up. Now this screen's kind of important because there's something that a lot of people get a little bit scared about. You can see that here's my max profit of $900. Now that would be in the case if and only if we reach June of 2023 and the contract expires worthless. But again, in our case, I'm not going to wait that long. but that could be the max profit I make. But look over here where it says max loss unlimited. Now that scares people, especially when you're new to options. Unlimited? Unlimited? I could lose an unlimited amount of money? That doesn't actually mean that they're going to come after you and rob you of your bank and your checking account and your savings account and oh my gosh, you're in complete trouble. No, no, no. That just means that you're losing an opportunity cost. The max amount that you could potentially lose, as long as you're not selling an options contract at a strike price that's under your average price that you bought your shares for, you'll be perfectly fine. What this means though is if you get assigned, which means that it's June 16, 2023, and the price of VTI is $211, which means your $210 strike price is in the money. That means you're going to lose your 100 shares. But here's the issue. Let's say it keeps going up and up and up. Well, you just gave away your 100 shares, and now the price of VTI skyrocketed to $300 per share. Oh man, just imagine if you wouldn't have done this options contract. You could have just held on and rode the wave from $210 to $300. You lost the opportunity of all that profit. That's what max loss unlimited actually means. Doesn't mean you're going to lose more of the money you already have. It's you lose the opportunity cost of future profits. But remember, in this case, because we're selling a covered call, we're actually a little bit bearish, which means we don't believe the stock price is going to go up at least anytime soon. So let's go ahead and sell this covered call. And then we're going to see what happens over the next couple of days. Now, there's a couple things you're going to see in your Webull platform. First thing you're going to see is right here. Now, in the app, it's going to collapse your covered call with your 100 shares that you're covered by. So in this case, you can see my $210. You see how it says open P&L minus $15? Don't worry about that just yet. You're going to keep an eye on that, but it's going to fluctuate over time. If it goes negative in the covered call situation, that means the price is actually going up. But what I'm going to do is I'm going to give this thing a couple of days and see if this price goes positive. Now, typically what I like to do is I like to focus on around 50% profit. Now, I actually got 10 extra dollars here. As you can see, it says $9.10, which means when I executed this at $9 a share, it actually popped up to $9.10 and I took advantage of that increase. So I got $910 immediately in my cash balance. That was amazing. But what I'm going to do is I'm going to let this sit for a couple days, and the goal is let it go into the green. At that point, I'm then going to buy it back, and I'll show you exactly how that works. The key is I look for around 50% profit, which in this case, right around $400, maybe $420, I'll go ahead and buy back the shares, which means I'll pocket $400 and give back the rest, the difference between $400 and $910. Now, even though I said that, that's kind of my cardinal rule is 50% profit. Because we're on a video here and I want to actually share with you an actual example, I'm going to break that rule and sell for a little bit less than 50% profit. Actually, a lot less than 50% profit. But let me walk you through exactly what's going on here. Here we are, and there's an opportunity now where VTI has actually dropped down since we initially executed the trade. So you can see here, now look at the collapse amount. It's $165 of profit. That's pretty darn awesome. So here's what we want to do. You want to tap on that particular call option in your portfolio. Once you do that, you're going to see this screen right here. Now, it's very important that you do not select sell to close. If you do sell to close, what you're saying is, I'm done with all this. I'll go ahead and take the profit and I'm going to sell you my shares right now. Don't do that. That's not what we want. We want to think like that house example. We're renting out our shares. We want the premium and we want to keep our shares. You don't want to sell the house. You get what I'm saying? So what we want to do is we actually want to tap on where it says VTI 210 short -1. Or in your case, if you have a single stock like Apple, you would click on where it says Apple short -1. So once you tap on that, it'll bring you over to this screen right here. This is the screen that you want to click on buy to close. So we're going to buy back this options contract, close out our position, and pocket the difference right around $100 or so. This screen will pop up saying, do you want to go ahead and buy back at the market price, or do you want to set a limit price? It's your option altogether with. I like to use limit prices in most cases, only because limit prices allows you to make sure that you're not getting taken advantage of wild market swings up or down one way or the other. But in this example, because this is a beginner's video, I will just do market for now. One contract at 100 shares in the day. Let's hit buy and see what happens here. Up pops a confirmation screen. You're going to be paying back $760 in this case. So if I'm paying back $760, what does that mean my profit's going to be? So if I take that $910 that I initially got when I sold the covered call and I subtract out the $760 I'm about to use to buy back the contract, that means my profit is $150, just like I said at the beginning of the video. This is how I made $150 in a very short period of time. So that is, in essence, how you sell a covered call, and it's your option altogether with. If you want to wait for a little while and kind of see how it rolls, see if it goes up and down, you can wait as long as you want, or you can make a faster trade if the market works in your favor. If not, hold on until you're a little bit closer to the expiration date, and then you can make the decision. The worst case scenario, the absolute worst thing that could happen to you in this case, you keep your $910 in my example, and you have to sell your 100 shares because you became in the money with that particular contract, which means the date is June 16th, 2023. That's the absolute worst thing that could happen. So even if your contract goes negative, as I shared with you earlier, don't let that stress you out, because at the end of the day, you already got your profit. All that doesn't matter. Worst thing that could happen is you sell your shares. And if you sold your shares at a strike price that was higher than the actual cost that you used to buy the shares in the very first place, you're still going to profit anyway on that amount. More options videos coming. Comment down below which one you want to see next in options. Check out this video next, and we'll see you on the next video.